My name is Ben Vecti. I am director of the WACARES Fund in Washington State, which is the first social long-term care insurance program in the United States. So it's I'll talk about it more in a moment. Before that, I was working at a think tank on social insurance in Washington, D.C. called the National Academy of Social Insurance, and worked on all kinds of social insurance programs, health insurance, pensions, unemployment, workers' compensation, Arbeitsunfall, all those things, and then as well as paid leave and long-term care. And before that, as I said, I was here at Biggs working on comparative social policy projects and a number of different ones. So today I want to talk to you about the WACARES Fund, which is a universal long-term care social insurance program in Washington State. I'll start by talking about why the U.S. needed a new approach to long-term care. What is the WACARES Fund? Why is it good for Washington? And excuse the normative framing here, but I also present to the public, so it's more normative Heinz than it would normally be. Why does WACARES support Washington families? How does it work? How is it administered and overseen? And then talk about our initial findings on provider gap analysis. So, as you know, it's a big problem going forward if there's going to be enough providers in this space. And then I'll talk about what we're doing around supplemental private coverage. We're working with the private insurance industry to try to develop supplemental coverage. I'll talk about that as well. So why do families need a new approach to long-term care in the United States? Well, it's important to understand in the United States previously, and still today everywhere except Washington State, if you're wealthy, you can pay out of pocket for long-term care. You have to be pretty wealthy to do that. And if you're poor, very poor, you qualify for Medicaid long-term care, which you get if you have, basically if you're a little bit above the poverty level or below, which is very low in America. And you have to have assets, life savings worth $2,000 or less. So basically no savings. So very few. So if you're wealthy, you're okay. If you're poor, you're okay. But for the broad middle class, you're just unprotected against this risk. And many people become impoverished when they need long-term care. And as we'll talk about in a moment, that affects not just the individual, but also their families. And our data show, and yours is I'm sure similar, 7 in 10 people who turn 65 today are going to need long-term care at some point. The annual cost of home care in our state is about $33,000 a year for 20 hours a week, and twice that for 40 hours a week. And the median household income for seniors is only $56,000 in Washington State. That's gross or brutto, income. And so, after taxes and so forth, maybe that's $40,000, and people just can't afford to pay for long-term care out of that. And it doesn't even take into account that people have healthcare expenses in retirement as well. In our country, the health insurance system covers some of it, but you have to pay a significant amount out of pocket. And half of Americans have no 401k or pension income. 401k is like the vista renta, like the individual savings accounts. Half of Americans have no pension and no individual savings. They do have Social Security, but the average Social Security benefit is about $15,000 a year. So a lot of seniors are living on just Social Security. The median household income is about $56,000, but it's just a fact that people are not ready to pay for this in retirement. And so families have a major crisis when this happens to a family, when someone needs care, and 7 in 10 individuals do need care. And as you know, often the man needs it first. If it's a heterosexual couple, the man might need it first, and then men die before women do on average, right? And then that depletes their life savings, and then the woman is there on her own with no one to help her, and very little money left over. So it's a major crisis for families. These are just some individual situations. For example, Carlos says, I turned 50 last year, and after caring for my mom, I realized I need long-term care insurance but can't afford it. It would cost me $2,700 a year. That is the average premium nationwide for long-term care insurance, $2,700 per year. Now, granted, that provides generous coverage, but that's the average premium. And insurance companies don't really want to sell less expensive coverage that has less coverage, less total coverage for a lower dollar amount, because in order to make a profit, they have certain fixed costs when they sell private insurance. You have to do underwriting, you have to do blood tests and all of the other tests to see what the risk is that you're pricing for, and you have to pay a commission to a broker and so forth. And so, what the middle class needs is affordable insurance, and very few can afford to pay this $2,700 a year. And what a lot of people forget in our country is that they may have a broker come to you and say, either individually or at employers, employers often bring in a broker to try to sell insurance to their employees, and they might say it costs $1,500 a year for you. But then as you get older, they can raise the premiums over time. There's no law saying they can't. They have to make the case that actuarially they need to raise the premium, but on average, premiums have gone up like 70% over the last 30 years. People who already had coverage, so the premiums just go up over time. And but what people forget is that you not only pay that premium when you're working, you owe it throughout retirement until the day you die or need care. If you're 85 and you're sitting at the kitchen table with your spouse and you say, we can't afford to pay for your heart medication, co-payments, as well as our rent or our mortgage payment and our other groceries. We can't, with all those expenses, if you're on a fixed income as you get older, typically if you have life savings, you spend those down, you run out of savings after a while. Oftentimes, if you're a couple sitting together at age 85 and you say, well, we can't afford to pay $2,700 a year for each of us, that's $5,400. So if you stop paying at that point, you lose the coverage. And so you paid maybe since you were 40 years old for 45 years. And if you drop the coverage then because you can't afford it, then if you're 87 and you need long-term care, you've got nothing. And you spent maybe $100,000 in premiums over your life for nothing. And so it's not being dramatic to say you have to pay these premiums until the day you die or need care, or else it's meaningless to you. So a lot of people struggle in retirement to keep paying, and many people drop the coverage in retirement. There was a study done in 2011 that's a little bit out of date, but it makes the point, which is that they studied if you leave the workforce if you're 50 or older and you leave the workforce to care for an older adult, the average lost lifetime income and retirement savings and Social Security benefits, so total lost resources from lost income, individual retirement savings or pension, and Social Security, which is on physical. You lose on average $303,880 by leaving the workforce. So people forget that, I know in my own family I have an example where my mom had Parkinson's and her husband was 60 years old when she became acute with it, and he decided to leave the workforce to take care of her, and she died 5 years later. And then he was 65, and he actually was a wie heißt es auf Deutsch? Pflege, CNA, like a Pflegearbeiter, Pflegefach. I don't know, Pflege.
Nurse,
yeah, certified nursing assistant.
okay.
Yeah.
Also Pflegefachkraft oder sowas, ja.
Yeah, okay, so he was working in a nursing home, ironically. So he was great for my mom. He was really good at caring for her. But then when he went back to try to get his job back, they said, no, you're too old. They wanted to hire 30-year-olds because, he's older, his back wasn't great. You need to carry people in and out of the shower. He couldn't do it anymore. So it's kind of a common case. When you leave the workforce at age 55, 60 for 3 or 4 years, it's very hard to get back in. So that's why the earnings loss is so dramatic for these family caregivers. And the AARP, which is our sort of BACTO, did a study and found that 25%, family caregivers spend on average 25% of their income on like things for their loved one, like a ramp or grab bars for the bathroom or whatever it is. So this also impacts the workplace, obviously. And this is really important. I think we try to make this point to employers in our state so that they understand the importance of this. In our state, there's 860,000 family caregivers out of 7 million inhabitants. Caregivers often have to leave work early or work part-time. As you know, here it's very common to be part-time if you're caring for someone to work part-time. And they may not be able to take on leadership roles in their firm. They may not be able to accept a promotion, for example. So like in my team is 90% women. We have 15 people right now on the team, and 13 of them are women. Many of them are in their 40s and 50s. Probably 5 out of the 13 have people in their family that they're caring for, right? And when you're in that situation, if we have a big project and I need them to really crunch something to get it done, like they can't work 70 hours a week. They can't work 1 week really intensively because they have other responsibilities. And often they have children as well, right? Sometimes you have both. And so we call that the sandwich generation. And so it really, and that impacts your long-term career trajectory heavily. It also impacts health. You know this well. Our demographics are actually, pretty bad, but they're better than anywhere else in the OECD. So the blue line here is population 85 or older in Washington State. It is going to double over the next 15 years. The population, the blue line here, 85 or older. And what's also important is that the people between like 40 and 64, or 50 and 64 on this graph, but there's another statistic for people 40 to 64. People who are in prime caregiving age, people who are likely, if the parent is 75 or 80, the daughter or the son, right? That cohort is thinning out compared to the cohort of people likely to need care. So in 2010, there were 7 people 40 to 64 for everyone who was, I believe it was 85 or older. I have the statistic in the notes field here, but I can't see the notes field. It was 7 to 1, the ratio of potential caregivers to people needing care. By 2050, it's going to be 3 to 1, the ratio. So there's going to be fewer people demographically who are able to take care of the aging population. It's probably true here too. And that affects not just family caregivers, it also affects the professional caregiving workforce, because those are also people likely to be doing it. So it just highlights the need for another kind of labor force solution, whether through workers or through a surrogate workforce policy like paid leave. And we spend 6.3% of our state budget on long-term care. And again, if that were to double over the next 15 years because the caseloads are doubling, that would destroy our budget. So that's why walk cares had to be introduced from our perspective, because if we didn't, families would be overburdened, employers would be damaged because people wouldn't be able to be productive, and the state budget would have basically been undermined. So what is the Walk Cares Fund? It's a universal long-term care program in one state, Washington State. No one is denied coverage due to health status, so there's no underwriting. It's just like, that's a contrast to private long-term care. So PLTCI means private long-term care insurance. So there's no underwriting. There was a study done recently looking at the underwriting criteria that insurance companies use. So underwriting means if you wanted to buy long-term care insurance and I was the company, I would send you to your doctor, have them do a lot of tests on you. And based on that, I would determine, first of all, yes or no, are we willing to insure you, or are you too risky? If you're not too risky, the question is, how risky are you? And based on that, we set our premium, right? Right now, 30% of people who apply for long-term care insurance are denied coverage due to underwriting. But but only rich people apply for long-term care insurance, and rich people are healthier. So there was a study done where they looked at the general population and said, what if, a lot of private insurance companies are lobbying in our country to say private insurance can be the solution for everyone, right? We don't need a public program. Well, if you applied the underwriting criteria to the general population, 40% of people would be denied coverage. So it just shows that a model based on underwriting is not a social policy approach. It's an individual business model for insurance companies, because it makes sense from their perspective. If you're trying to make money by selling insurance, you want to insure healthy people, you don't want to insure sick people. But it's clearly not a social policy approach. It's an earned benefit, so only those who contribute are eligible in social insurance. And it still keeps Medicaid as a backstop. So if you exhaust our benefits, so our benefits is a lifetime benefit of $36,500. It's significant benefit, but it doesn't cover everyone's needs. And so we still have Medicaid as a backstop. So if you use our benefit, and then you are poor, at the end of it, you will qualify for Medicaid, much like hitherto here. We have the same backstop. Not the same, but analogous. It's affordable contributions, which are about 0.5% of your wages you pay in. Very low premium, compared to, I guess, 1.5% for workers here, plus the 1.5% match by employers. Now, one problem we have in Washington State is that we don't have an income tax in our state. Most states in America have an income tax. We don't. And so we have high sales taxes and other taxes. So we don't have any data at the state level on what people earn. So we have no way of collecting premiums or Beiträge from self-employed people, because all we can do is ask them, tell me how much you earn, and they'll say, I earn $500 a year, and they'll pay 1% of that, and then they're insured. But that's clearly not actuarially sustainable. So what we do now, so we're struggling with that. So we left the self-employed out of our program for that reason. But they can voluntarily participate if they want to. And we're trying to work with the IRS to get data on federal data, but the federal government doesn't like to share that data with states, and it takes 2 years to get it approved. And even then, it's very difficult to use the data because there's lots of restrictions around it. But as a result, we have a narrower tax base. One of the advantages you have in the German system is that it's because you can levy premiums on older adults. Die tragen bei genauso wie Jüngere. You have a broader tax base. So that not only helps, so that has several advantages. Here you can insure people, so we can't insure anyone who is 65 or older today. It's a transition cohort problem where we just have to leave them out. And basically, people who are still in the workforce are going to earn benefits, but if you're already retired, you're not covered. So that's a problem that obviously hurts us politically, because those seniors don't support the program very much because they're not benefiting. They don't have to pay in, but they also aren't benefiting, and they're kind of upset about that. Beyond that, it's also an actuarial problem for future cohorts, because if people like everyone in this room, if we were all paying not just till we're 65, but until we're 85, until we die or need care, then we'd be paying for if I'm 40 today, I'd be paying for 45 years instead of 25 years, right? So the average person, if you start working at 25, say, you'd pay from 25 to 85, it's 60 years of contributions instead of 40 years if you retire at 65. So it makes our tax base narrower, which means the premium has to be higher than otherwise would need to be. We have a low premium, but it's also a low benefit. It would be better if we could have a much higher benefit, but to do that, we would need to have a broader tax base or a higher premium. The benefit is flexible. You can spend it's kind of like a budget, like they do, I think, in Holland now for home care, where you get a budget of $36,500. You can use it however you want. You can, as long as it's long-term care. You can get grab bars, you can get a ramp, you can hire a home care aide, you can get meals delivered, you can get transportation, pretty much anything that is long-term care. The contributions, I don't think I need to explain this. Well, the left column is pretty obvious for Germans because it's the way it works in social insurance generally. The middle column, certain workers can apply for an exemption. So we determined, sorry, I have a pollen allergy. I do not have corona, I promise you. I had corona a month ago, I recovered, and I got a booster 2 weeks ago, so I do not have corona. But I was walking here, on the way here, I could see pollen floating in the air. It's really tough if you're allergic. So when you do this in one state, there are certain problems you have. Well, not only, there's a couple of problems. First of all, some people live in Idaho or Oregon, the neighboring states, or even in Canada, and commute to work in Washington State. Those people were initially in our statute were required to pay into the program, but they couldn't benefit because to benefit you have to be in Washington State because our provider network is geographically limited. It's the home care agencies who are licensed with our state and the long-term care facility, the nursing homes that are licensed in our state. Because long-term care is a highly regulated system in order to protect older adults and people with disabilities. It's highly regulated. So we don't have any way to regulate providers in Idaho or Oregon. And so one of the fixes we had to do is create an exemption for people who commute to work but live elsewhere. Also, we determined that These are all things we didn't think of initially in the statute, but we fixed afterward. People who are on non-immigrant work visas. So a visa that lets you work in Washington State or in the United States, but then you don't get citizenship status for it. So it means you have to leave after a few. There's certain visas like farm workers and others, certain tech workers, where you're only allowed to stay for a couple of years. So we exempted those people. They're not required to pay in because if you're not going to be living in Washington State when you're 85, it doesn't make sense to require those people to pay in. And then spouses of military, if your husband or wife is in the military, and they're required to rotate every 3 years, so they wouldn't be able to benefit. Veterans with a 70% or greater service-connected disability already have long-term care through the Veterans Administration, so that would have been double paying for them, so we exempted them. And the last one was in the original statute, which is that people who had private long-term care insurance before our program was implemented are allowed to be exempt because they already have coverage. The typical Washington State income the median income for the people in the workforce is $52,000, which means the median contribution is $302 a year, or about $24 a month. We have a lot of trees in Washington State, which is why we took the tree as we use that a lot for our pie charts. So what do employers need to know? So there is no employer match. So all they do is collect the premiums for the workers and remit them to the trust fund, and that's all they have to do. Still, we were sued. Our program was sued by various parties, claiming that it was an employee benefit, which is, in our country, states are not allowed to do things that improve Social Security for workers, for employees, because that's federal responsibility, because there's a law called ERISA from 1975, I believe, or 73, the Employment Retirement Income Security Act, which was designed in the 70s to protect workers from being exploited by things like pension plans, which are tax deductible for the employer, but back then they only benefited the highest earners. So ERISA said you have to have if you have a pension plan that's tax deductible, it has to benefit the entire workforce, not just the highest earners. But then courts over time, as the neoliberalism took hold in the 80s and beyond, reinterpreted that to mean, because it's a federal law, there's a federal law regulating employee benefits, states are not allowed to do things that make health insurance more affordable or anything like that. So we were sued on that grounds, and we won because the courts found that this is not an employee benefit, it's a public program. The reason they thought they might be able to win was because the premiums are collected through employers. And so they argued that it was a kind of an employee benefit, but luckily we won that case. There have been multiple attempts to eliminate our program, legislatively and through lawsuits, but so far we've withstood all of those efforts. Qualifying, so it's a little bit complicated. So this was done as a funded system primarily. So we collect premiums starting in 2023, next July. We collect for 3 years, and then in 2026 we start paying benefits. I know in Germany you paid the next year pretty quickly, in 95 and 90, yeah. But initially you had to pay in 10 years to be fully vested and get. Is vested, does everyone understand that word? How would you say it in German? Vested, like when you've earned the right to benefits through paying in?
Leistungsberechtigt.
Leistungsberechtigt, yeah. 10 years you'd have to pay in. So the original statute said you had to pay in 10 years because that made the premium lower because we have our actuaries who do analysis of how high the premium needs to be to pay for our benefits. If you have a high vesting threshold, then some people won't meet that, and that means that they're not going to benefit, but it helps keep your premium low. Or for people with disabilities or people who are close to retirement, we had a rule that if you paid in 3 out of the last 6 years at the time you're applying for benefits, you could also be eligible. But do I have this in the next slide? Yeah. But both of these left out people who are near retirees. So if you're, say, 57 right now, and you think you're going to work 8 years, that means you won't be fully vested when you're 80. So that was a problem, and a lot of people close to retirement were upset about it. So This past year, we created a new coverage pathway for near retirees, where anyone born before 1968 can get prorated benefits. So every year you pay in, you get 10% of the lifetime benefit, and that's a permanent vesting. So that at least gives make sure people are getting something for their contributions, which you should in a social insurance system. If you pay in, you should be benefiting. So it's administered as a cross-agency project. The Department of Social and Health Services is my agency. We're the lead agency. We're going to build a beneficiary portal, like a website, where people can come to apply for benefits, claim their benefits, track their claim, etc. The Employment Security Department, ESD, it collects the premiums from the workers. They do that for other social insurance programs. They collect it from the employers on behalf of their workers. The Healthcare Authority, HCA, is the agency which pays providers. So they manage all of our state health insurance programs. So providers provide services, they bill the Healthcare Authority, and they get reimbursed. The beneficiary doesn't have to touch money at all. The beneficiary, if I'm 85 years old or whatever, I find a provider, and then the provider, I tell the long-term care system, I tell our agency, hey, I want this provider to be my provider. The provider provides the services, and the provider bills the state and gets paid. So the older adults don't have to deal with it. And then there's a state actuary who monitors our finances. So, this is obvious to you, but the old system was, long-term care insurance was unaffordable for most. Only about 7% of people had it. There was a fear of not being able to stay in your home as you age, anxiety around the financial burden and family burdens of needing long-term care. And really the pathway for most people was, when you need care, you spend down your life savings, become impoverished, and then you could get access to care. And that's no one's utopia of aging, right, is having to do that. So the new way is that we have affordable long-term care insurance for everyone, peace of mind, and it's affordable because you stop paying when you retire. So as soon as you stop working, you don't owe anything. So you pay when you're able to pay, you pay. When you need benefits, you get them. Peace of mind that services will be available when you need them. It allows the families to focus on care rather than money when a care need arises. And you can choose whatever mix of family and professional care you want. So one unique aspect of our system, well, you have it here as well, but I think Japan doesn't have this, but you can pay a family member. So you can pay your spouse. Your spouse can be a paid caregiver. So I know here you can get cash benefits. But I think in our system, it's actually probably more money that goes to the family because the family member gets paid just like a home care agency would. And you can unlimited. I could use the entire $36,500 on my spouse or my son caring for me. They would have to just tell the state what hours they worked, and they get paid per hour. We have a lot of different cultures in our country, as Germany does now too. And some cultures prefer to have family members take care of them. Some prefer to have professionals take care of them. And it gives a lot of flexibility for that. We also did a provider gap analysis. I won't go into detail on how we did it, but this was the methodology. And we found that the main gaps we had were in-home personal care. So we have area agencies on aging in our state which manage the aging services network. And what they told us, we surveyed them, I believe it was 13 of them, and this is what they mentioned as their main concerns. 9 of them said lack of home care agencies and home care aides was the biggest concern. 7 said lack of transportation infrastructure, particularly in rural areas. There aren't a lot of providers in that area. Environmental modification, like grab bars and things like that. 6 mentioned that. 4 mentioned home delivered meals, and 3 mentioned supports for caregivers. The barriers they saw to having an adequate private network, the main barrier that they said was they're kind of telling us what the providers are telling them, was that the pay rates are too low from the state. That was their main concern. So it's not worth it. It's not profitable for them. They could still provide to, if I'm a home care agency, I can always provide care to rich people who have private insurance or who pay out of pocket. If I do that, I can charge more than if I'm doing it through the social insurance program. So a lot of them don't even bother working for the state. 10 of them mentioned billing and payment system challenges. They think it's too bureaucratic, the way you have to to submit your reimbursement request to the state. 9 of them said lack of training and field support, so our training system, education and training is insufficient. 9 of them mentioned contracting difficulties. Again, they have to have a contract with the government. They find that burdensome. And then we have very high, in Washington State, we have the strictest qualification requirements for providers. We require a lot of training, and a lot of them thought that was a burden as well. So I want to shift now to talk about one last topic, which is supplemental private coverage. So because our lifetime benefit is $36,500, that covers for about a third of people. That will cover almost all of their needs. About a third of people about 28% of people in the United States only need long-term care for a year or less. So for them, you can get about a year of home care through our program. But then, 2/3 need more than that. There's like a middle third that needs between 1 and 3 years, and then another third that needs more than 3 years. And for them, this isn't enough. Now, nobody knows ahead of time which group they're going to fall into, but people are aware that it's not enough. And so, I would love to be able to have a benefit that's, $100,000, but that would require a premium that, would be more like 1.5% of income. And there wasn't political support for that, and there still isn't really. Maybe after the program has existed for a few years, like in Germany, the premium started out, what was the initial premium? It was like 1% initially, 1.5%, and now it's 3%.
1 and 3 now.
Yeah, so, it's gone up significantly. So maybe that will happen, but we also have a very strong private insurance lobby in our country, and so in the legislature now is, they like the idea of a public-private partnership where we have the public sector takes the first risk, the first 36.5, and then because we're taking on the first risk, it should be cheaper for private insurers to insure the risk above $36,500 because that means if the average claim is, say, $80,000, instead of having to insure $80,000 of benefits, they only have to insure, 80 minus 36.5. So they're insuring, it's a smaller amount that they have to insure. The premium should be more affordable, so our hope is that for the broad middle class, that we can create a supplemental private insurance market that is affordable for people. So that instead of having to pay $2,700 a year, maybe it's $1,500 a year or something like that. So we had created a work group. We're working with private insurers now to try to design this market. And of course, from the state's perspective, we're focused on consumer protection. From the insurer's perspective, they're focused on profitability, and we're trying to somehow reach compromises. So the challenges around consumer protection is, first of all, that private insurance, even though it's highly regulated, it's a very complicated product. So consumers don't understand it. If I'm an insurance broker and I go to you, I could say, how much coverage do you want? Do you want 50,000, 100, 150, 200? And you probably won't know how much you need, right? And then they may tell you, well, let me tell you a story about somebody who was in a nursing home for 5 years, and they'll say it was their mother or their father or whatever. And then you might think you need $200,000 of coverage. But then when you go to claim it, so private long-term care insurance, in our country at least, is designed to be hard to get and difficult and expensive to use. So it's designed to be hard to get because there's adverse selection, because it's voluntary. And so people don't buy it unless they think they're going to need it. And there's underwriting involved and all that, so it's hard to get it. And when you want to use it, to manage their costs, they have what's called an elimination period, which is a waiting period. So when you need it, when you meet the threshold to be eligible for the benefits, they make you wait maybe 90 days, where you have to pay, not just waiting, not just time, you have to actually prove that you paid out of pocket for care during those 90 days. And that's the standard policy. Sometimes they have up to a year elimination period where you had to pay out of pocket. So if you don't have enough money to pay for those 90 days or that year, you can't use your benefits. You can only use them after you paid for a certain period of time. So people don't understand that when they buy it, and they don't understand the premiums continue until the day they die, and so maybe they can't afford to continue paying the premiums. And so it's a very complicated product. And also they'll offer you 10 different options for different types of things that all affect the pricing, and people don't understand it. So that's a problem, and I'm sure Heinz can tell you what the term is in economic sciences for that, like asymmetric information or something like that, right? then it's difficult. So it's a dysfunctional market. We're trying to establish some regulation in the sector. We're trying to create something called supplemental coverage to walk carriers, which is where we regulate just coverage that markets itself as supplemental to our program. Because we're never going to be able to regulate the rest of the insurance industry, but we might be able to regulate things. So we say, if you're going to sell people in Washington State and tell them this is supplemental to walk carriers, we want them to meet certain conditions so that it really does work for consumers. For example, we want to develop a consumer guide that we send to people that helps them understand their choices. We want to expand it. There's an advisory service called Sheba, which advises consumers where they can call and get advice. We want to create a new statute that regulates this market. We want to require a range of disclosures where we tell people all the things that they need to know, including a best interest standard, which is a fiduciary standard, saying that when you're selling policies, you have to sell policies that are in the interest of the consumer, not in the interest of commissions or something like that. And require that inflation protection be offered at a minimum of 3%, because if you don't have inflation protection in your benefit, if I buy a policy when I'm 35, it'll be worth a third of that when I'm 85 because of inflation. So that's another thing that consumers don't understand. Another area we have challenges is in the benefit trigger. So private insurance uses something called the HIPAA trigger, which is in federal law, in order for a policy to be tax qualified, which means that the premiums are potentially tax deductible and the benefits are not taxable. In order for that to be the case, you have to use the federal trigger, which is 2 ADLs and or severe cognitive impairment. It's a pretty high threshold. And so that's why it's hard to qualify for private. It's hard to claim your private benefits because you have to be pretty advanced before you're eligible. The Medicaid program has a much lower trigger. It's much easier to qualify because it's a public program. So our Walk Care's social insurance program uses the Medicaid trigger, which is a much lower trigger. But that creates we call a donut hole. So a donut hole is a gap in coverage. So, donut, if you come from one side of a donut, there's a little bit of donut, then there's a hole, then there's more donut, right? So this is, for us, somebody would have walk cares first, then they would exhaust the 36.5, and they may not yet meet the HIPAA trigger, the more higher trigger for private insurance, so then they have to pay out of pocket until they satisfy that trigger, and then they're eligible for private insurance, right? So and that's hard if you have dementia and you're 85 years old. You may not be able to pay for that in the gap between those two, and so that's a challenge. So potential solutions that we're looking at is that instead of requiring that people have to meet the more advanced, the higher trigger to qualify for private insurance, for this specific market, and it looks like we're going to be able to achieve this, the private insurance companies say, as long as you've exhausted your walk care's benefit, we will deem you qualified for the private insurance. That's one. We're trying to get that. It's not clear yet. We're still negotiating. Or at the very least, say that there's something called this waiting period, or the elimination period, is the period of time that you are required to pay out of pocket before you can qualify for the private insurance. That 90 days, for example. We want to say that if you've used your walk care's benefits, that they say you've satisfied that Untitled, that paying out of pocket for a while. So those are things that we're working on. It's hard to get these two systems to work together. There's a lot of challenges, but those are things we're working on. So another thing is that our benefit is kind of like in Germany. It's the inflation protection for the public insurance benefit is a manual inflation adjustment. There's a council that gets together every year and decides, based on inflation, how much are we going to increase the benefit. And so it could be that if they think that we're not doing well actuarially, that they don't increase it at all for several years. And so if that happens, but the private insurance companies are trying to design price policies with a deductible of $36,500, and once they issue that contract and they sell the policy, that's written into the contract, doesn't change. And so, or they could put a specific inflation to the deductible, like say 3% or something in the policy.
But they don't know how much the public program's benefits are going to increase over time, so they don't know how to price, they don't know how to do their deductible because they don't know what the public benefit's going to be. So it's like two puzzle pieces. You want to fit them together, but it's hard. So we're recommending to the legislature that they make our inflation adjustment automatic rather than manual so that this fits together better. But if we do that, we lose a cost control mechanism. It's a really important cost control mechanism to be able to control how much you do your inflation adjustment. So that's another challenge. I think I'll stop there and open it up for questions.